we are talking about, various kinds of mutual funds. So let's go back to, these funds. So we have, historical returns. Okay, so we come here. Okay, so we know that in equity, there are about 12 mutual funds, 12 categories of mutual funds. Now, here you're giving a mandate to the mutual fund manager to invest either in large cap funds, if you have chosen a large cap fund. If you have chosen a mid cap fund, then you are asking him to invest majorly into mid cap funds. And in small cap funds, you are giving him mandate to invest only in small cap. Now, if you don't want to take any risk, or want to take risk, but little bit risk, then the large cap price. Of course, investing in equity is basically risky. You can even lose your money. But the large cap compared to large cap, mid cap, and small cap, the least risk is present in large cap because it is investing in top 100 companies or the blue chip companies of India. Whereas the mid cap invest in a medium sized companies from, the 101st company to 250 companies in India. Okay. So, and then we come to the small cap, which is the most riskiest. So if we go to, a screener and see, you know, a fund and see which fund covers, we say NSC, large and mid cap, or rather we say large and mid cap. So we'll get the screen, large and mid cap. So this is, the top 250 companies. That means the top 100 companies in India plus another 150. That is, the mid cap. So this is called the large mid cap index. So if you see, this covers about, quite a big amount of market cap, 3 crore 66 lakh 80,000 crore is the total market cap size of all the companies, 250 companies of India. Currently, the index is hovering around 16,501. Today, when the market opened, it has gone down by 0.21%, and it has touched a high of 17,000. Maybe in September or October last year, and now it is done the low of 13,000 also. Then, if you look at the P ratio of the large and mid cap, it is 26.8, slightly more than the large cap. Price to book value is also higher. These companies trade normally at a higher level compared to the the top 100 companies. The dividend yield is almost the same, 1.06%. And this fund has also has underperformed in last 1 year, giving a negative return of 2%. In the last 5 years, the fund has given 23% return, so which is a phenomenal return. And that in 10-year frame, it has given 15%, which means that if you invest in the large and mid cap companies of India for a period of 10 years, historically, it has given 15% return. So that's a very good return. And if you just go to the price chart also, then we can go to all these companies, which are all 250 companies, which are there. Okay. So now we come back to, okay. Now we're talking about, the equity funds. Okay. So we have the multi-cap fund. We'll talk about that later. We have talked about large cap already. Large and mid cap, here these funds, they have investing in large and mid caps. So minimum 35% of the investment in each, that is large cap and mid caps, should be invested in this kind of a scheme. And now this is basically, we have just shown you a graph also where we've gone to the screener where this is covering the entire 250 companies, large and mid cap. So this is called large and mid cap. So that means this the fund manager is going to invest in 250 companies of India, considering large cap and small cap. Then the mid cap, which we have already covered, small cap we have covered. Then we have the equity linked saving schemes. Now, here you invest in these funds to save your tax. Now, only under the old regime. In new regime, you're not entitled for Section 80C deduction. That means you don't get any deduction under Section 80C if you're filing your return under the new regime, where you have to pay a lower tax, okay, at a slab rates which are wider in this thing horizon. Whereas if you choose a old scheme, there you can take the benefit of Section 80C and you can invest up to 1.5 lakh rupees in these funds. And there is a lock-in period of 3 years. That means if you have invested, you can't take out the money, before 3 years, but you can save tax. Suppose you come into a 30% tax bracket. So that means you get a 1.5 lakh rupees you can invest, and you can save about 45,000 rupees of your tax liability. That is 1.5 lakhs into 30%. Okay. Then we have dividend yield funds. Okay. So basically, these are, the funds where, the fund manager invest in companies which are paying a lot of dividend, because most of the companies, pay dividend. Some of the companies don't pay. So it is not mandatory for the companies to pay dividend. Now, some people, they fancy in investing in those companies which pay dividend. So the fund manager is going to choose only those companies which are paying dividend, so that you get a recurring, return, as well as, capital appreciation on the price of stocks. So this is called dividend yield fund. Then we have sectoral thematic fund, which are more riskier in nature because they are going to invest only in sector, like, IT, pharma, banking, so infrastructure. So these funds, they choose a theme or a sector, and they invest in those kinds of sectors. Like, if you want to, you're bullish on banks, but you don't know which bank to invest. So invest in a fund which is investing in uh, banking companies. Okay. Now, why they are riskier? Because they park all of your money in only in one sector. Something happens wrong to the sector. Suppose the government announces something, like, for example, IT sector. Now today, all the IT stocks are coming down because the visa announcement which came in America, where, new visas will not be, or will be issued at a very high price. So it has dampened the spirits, and IT companies are today falling because of that announcement. So if you have invested in the IT sector, then today is the day when you're going to, get a very negative returns, and maybe in the coming time, it will perform poorly. So you take a risk when you're investing in a thematic fund. Then we come to After that, we come to a contra fund. Now, they invest against prevailing market trends, focusing on undervalued stocks expected to bounce back. Now, they are going to choose only those stocks which are, which are falling, or which is, undervalued. And the fund managers have a contrarian strategy. They feel that the funds have, or the companies, which were not performing now, they're going to perform better in the coming time, whereas the whole of the market doesn't, go with them. They're thinking. So, like, about 7, 8 years back, all the pharma stocks were coming down, and there were certain fund managers who thought the worst for the the companies were over. So, they started investing in pharma, and in the next 5 years, the pharma stocks were doubled. So these are called contra fund, so contrarian strategy, or a long-term horizon needed. High risk, but potential for stronger returns if the bets succeed. It all depends on the fund managers, thinking that if it is worst is over for the farmer, then the pharma sector is going to do well. Otherwise, you're going to witness some more downfall and lose your money. Then we come to, a focus funds, where, these focus funds are where, the fund manager is going to invest only, say, a maximum of 30 stocks, which is as per the SEBI regulations. So they are going to, not invest in 60, 70, 80 stocks, which normally a fund manager is going to invest in. If you choose a large cap fund, like Nippon has invested about, into 64 stocks. So they're going to choose only 30 stocks. Okay. And they're going to follow those 30 companies with which they have a major conviction that these companies are going to do very well. Then we come to the value stocks or value funds. Now, value funds are basically the companies, they invest in companies which are currently trading at a lower value compared to the market. And that means they command a lower P ratio, or all the, P multiples. They are undervalued to the intrinsic value. When we say that the intrinsic value of a share should be 100, where the share is trading at only 80 rupees. So this company is going to do very well. So the fund manager is going to invest in those kinds of stocks which are going to do well in future, but because of some reasons they're trading today below its intrinsic value. Then we have the flexi fund. Okay. Now I told you there is a two kinds of funds: flexi fund and um, multi-cap fund. So we try to understand, what is the difference between a flexi fund and a multi-cap. Now, as per SEBI rules, of course, they look identical, flexi cap and multi cap. Now, in flexi cap, as per SEBI rules, 65% of the money should go into equities and no fixed cap allocation. That means you can invest in any of the fund, large cap, small cap, mid cap. So at least 65 plus should be going into equities. Whereas if it is a multi-cap fund, then 75% in equities and minimum 25% each in large, mid, and small caps. So that means the fund manager has to invest at least 25% in each of the category, whether it's large, mid, or small caps. So Flexi has a more flexible, kind of this thing. The fund manager gets, he can invest in any, he can invest, everything in a large cap and ignore a mid cap, a small cap. If you think the large caps are going to do well, if you think the mid and small cap time has come, so he's going to invest more allocation to, mid caps or small caps. Whereas multi caps, minimum 25% allocation has to be there in each of the cap. Okay. So, flexi cap, they are, risky. If you look at the risk parameter, then multi-cap funds are more riskier because here you are putting your money in a mid and small cap, irrespective whether those funds will do or those companies will perform better or not. But in flexi cap, the fund manager, chooses the companies which are going to do better. Okay, so these are the various kinds of uh, differences between the flexi cap and multi cap.